Welcome back to the podcast. Don't forget to go to the website at retireyoungaudio.com and leave us a comment. Also, subscribe to the Retire Young podcast at Apple Podcasts, iHeartRadio, and Spotify. Al, as we end that last segment, you referenced a term that I want you to explain. And, you mentioned how the markets have three directions. They go up, they go down, they also go sideways. Everybody understands how institutions profit in up markets and what that concept is. Most people don't understand that concept of how institutions profit in down markets. Now, explain what that is. I'm going to give you a hint. It's not tall.
It's anti-tall.
It's anti-tall.
Tall challenge.
There you go.
Or maybe short. Shorting, is that the word we're looking for, Josh?
Hey, you're so smart.
How about you said that earlier.
I did.
I guess I just proved it. Yeah, shorting. Well, the market is down a significant amount of time. Maybe not quite as much as it's up, but it's down a significant amount of time. So that's an opportunity that really can't be missed if someone wants to be consistent and have the potential for the greatest performance in the portfolio. Shorting is one way of doing that. That is basically borrowing something you don't have. Let's use Apple as an example. If you think Apple is going to go down in value and you would like to have the potential to profit from that or participate in that, you don't own Apple, you can go to your broker. Actually, all you can have to do is just pull up on your trading platform on your computer. There's a button there that says short or sell short.
Yeah, it's all electronic now.
It's all electronic now. And that's a big advantage for us because we have the ability now to do these things on a very rapid basis. But what you do when you activate that short position, you are borrowing shares of Apple. So it may be that if I short Apple, maybe they're loaning me Josh's shares of Apple without telling him, and they will let me sell those shares at the market right now. That money goes into an account and is held there until I return those shares that I borrowed.
And there isn't any transfer of ownership or anything there. Remember, it's just electronic. It's a computerized.
Correct.
I don't know technology, but it's a model that they have.
Sure. The goal there is if you feel that Apple, in this example, is going to go down, the goal is to sell it at a certain price, buy it at a lower price, and then return it. And you have to return it because you've borrowed something and you sold it, so you no longer own it, but you have the obligation to return it. So that's shorting. You can short individual assets. You can short the markets in general, primarily through exchange-traded funds. Institutions do that on a regular basis. If let's say that someone is trading in an IRA, you cannot short in an IRA. Does that mean you can't participate in down markets? No, you still can. You can use options. A put option is essentially the same. That will go up in value as the underlying asset goes down in value. And there are inverse ETFs. An ETF is an exchange-traded fund.
Yep.
Similar to a mutual fund. It's a basket of stock, so it has good diversification, very low cost of participating, and it trades like a stock. You can buy and sell it during the day. An ETF that goes the opposite direction of what it's intended to mimic is called an inverse ETF. For example, with the S&P 500, if the S&P is down 10%, the inverse should be up about 10%. And there are leveraged ETFs that will go 2 or 3 times the amount of the underlying.
Yeah, and just think of it this way, to make it in simpler terms is when you buy to open, you want it to go up to profit. Same thing when you want it to go down, you sell to open and then buy to close.
Correct.
It's just an open and then close. That's all it really is. And most investors are in this one-dimensional strategy, which
Correct.
is buy and hope it goes up. I mean, think of that strategy as having a car and having only drive in your car, not having reverse. I mean, you may get somewhere. It may take a lot of time, but if you're going to try to get into a parking spot, you're not going to get into that.
Yeah, or you may have to drive through the back of your garage just to get onto the street. That's exactly right. And the key is to understand which assets can be used in different market conditions. So there's a couple of things that are important. Number one is identifying the right price to either enter into something that's opening a trade or investment, or getting out of it, closing it, or going short, or by using one of the assets to make money in a down direction. So it's identifying the right price, because it's like real estate. In real estate, people always say it's location, location, location. The same thing is true in trading and investing. It's location, 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 but it's price location. And that is part of a strategy that our students learn, which gives them a high probability of identifying, a good price to enter, a good price to exit, to sell, based on institutional activity. And then the second part of a good position is knowing which asset to use. It's sort of like when you driving. When the first thing you do, you don't go out and pick a car first. First, you learn how to drive. You take your test, your behind the wheel test, your written test. Then you decide which kind of a car to get. And the same thing is true in trading and investing. Understand how the markets work, how to identify a price that gives you a low risk entry with a high probability of succeeding, with a high profit potential, and then understand or utilize the right asset to get the greatest benefit out of that particular position.
You're exactly right. You want to have that right asset, but you kind of open up a can of worms as well. You mentioned, where to get the right price to get in, the right price to get out. A lot of investors, they feel a little nervous when they're placing or making decisions in the markets.
Sure.
An easier way to do that is something we call set. You have your stop, have that predetermined, your entry point, which is the E, and your target. It's that set trading mentality, and it's just that way you know where you're going to get in, where you're going to get out, even before you place that trade, and that's where you have more comfort and more confidence in your trading and investing decisions.
Right.
And Al, we talk a lot about these in these investing classes.
We do.
Al, you mentioned having the right assets,
Yes.
and when institutions are trading for income, they're in the right assets. They're not just buying and selling stock, because we all know stock requires a lot of capital. That's what the brokers require. Let's talk about these other asset classes. What are the right asset classes, especially that the institutions are using for trading for income, that's also available to the public?
Well, there's a difference between how you trade or how a person trades for income or how an institution trades for income and how somebody, an investor, would invest long-term for wealth, for building up your retirement accounts and your wealth portfolio. And the interesting thing to me, Josh, is that the institutions, Wall Street puts their clients into mutual funds or annuities, maybe in some cases some stocks, but they put their own money in not just stock, but in the futures market, in the foreign exchange market, in the options market. Why is that different? Well, one of the reasons is that futures and Forex especially are shorter-term trading vehicles. Brokers oftentimes have several hundred clients that they are working with, and if, let's say, every one of those 200 or 300 clients wants to trade in the futures market, that's, and I'll explain that market in a minute, but that's a short-term trade. Sometimes you're in and out of a trade in a day or maybe a couple of days. How can somebody possibly do that with 200 or 300 people?
You're right.
The easy way to do it is to put them in a mutual fund or some kind of an asset grouping. Just tell them to hold on. Don't worry about the drawdowns. Don't worry about the corrections. But
warm and fuzzy feelings, isn't it?
Yeah, well, it isn't so warm and fuzzy when you see the market go down 50% or 57% as it did in 2000, 2008. And, we had a big drawdown this year, too, in 2020.
Yeah.
That's not warm and fuzzy. That's what keeps you up at night sweating and increases stress. That you should never have to go through that.
So just clarify something, Al, because a lot of investors, a lot of listeners, they say, okay, I can't be a short-term trader. Sure. That doesn't mean our institutions sitting at their desk like the movies portray and sweating and placing as many trades as they can. Is that what they're doing? Or are they doing what we were talking about earlier, setting their positions and then letting the position work for them?
That's exactly what they do. And that's what I think everybody has, or I shouldn't say everybody, but most people have a misperception of what a trader really is and what trading and investing is. It's not sitting in front of a computer. In fact, that's probably the worst thing you can do because your emotions will get involved. You'll start making decisions based on not what is factual, not really what is reliable, but on what your gut and your brain is telling you. Almost always that's going to be wrong over a period of time. So, no, the institutions are not putting their money in a long-term portfolio and using that for short-term income. Everybody should have a long-term portfolio, whether you can do it now, whether you have the additional assets to do that now or down the road. But it should be a combination of income and long-term saving. Income, if people need cash on a short-term basis. You don't do that with a long-term portfolio that you are supposed to hold on to for 10 or 20 or 30 years. You might need income on a daily or weekly basis. The institutions are doing that. That's where the short-term trading vehicles come in. Futures, probably the best short-term trading vehicle. That's where you're looking at what something is going to be at in the future. Is it going to be higher? Is it going to be lower? It can be the major stock markets. It can be commodities. A number of farmers use commodities. It can be oil, gold, silver, currencies, interest rates. Airlines use futures contracts to lock in the price of their jet fuel, which is probably one of the biggest expenses they have. They need to know what that expense is going to be to do their budgeting. Companies like Cargill and General Mills do that because they're in the grain business. So futures it's a great asset to trade. It has great leverage, great liquidity. And by leverage, I mean that every dollar that is invested in a futures contract controls a multiple of that dollar, say 20 to 1 or higher.
Let's break that down, Al. A lot of listeners think, which is true with the stock market, you need a decent sized portfolio to get involved.
Sure.
Brokers require less with that asset class.
That's right. It allows people that might not have a large portfolio the ability to participate. A lot of people that are retired that don't want to take a large amount of their retirement money to have a stock portfolio can maybe participate with a smaller amount of money in the futures market or Forex or options market. But again, those are things the institutions are using on a regular basis. Goldman Sachs is not paying their traders hundreds of thousands of dollars a year to put together a long-term portfolio and then just sit around drinking coffee, waiting 10 or 20 years to see how that portfolio performs. They're trading on a daily basis.
You're right. And these concepts and these different techniques that these institutions are using, they're not new. They're just a little bit different. They're different than what the public is doing, the masses, the average person. And it's available to the public. The public can do the same things
absolutely.
the institutions do.
Sure.
It's just they haven't been educated on. That's why we talk a lot about financial literacy and financial education on this program here. But it's all about becoming more comfortable, but also confident in your decisions. Thanks for listening. Don't forget to check out the website at retireyoungaudio.com and leave us a comment.